Good morning, everyone. This is Thursday, the 30th of November, and we're going to check out what's going on the market. There are a couple of changes, so I need to highlight a few things within the economy and also, and mainly in today's live, in the technical chart, which is going to be presented to the pro members. So the first half of the live stream is going to check out the economy, the six main drivers of the economy, as we usually do. And we're going to start with the macroeconomics. There's a couple of interesting things happened this week. So as we know, there is a declining US new home sales, which is not too dangerous, but we are getting out of the little correction trend that we experienced from the middle of 2022. And if the number is not able to get higher, then probably a little bit longer decline starts in a trend-like movement, which means that the supply could get a little bit lower, and in the next 2 to 3 years, we can experience some of the inflationary effect of this data. But nothing for the short term. It's a little bit less than the previous number, and obviously this is not a positive effect on the DXY, but it's not the most important data what we received this week. However, there is a declining BOG core CPI which came in Tuesday, and the new number became 3% after 3.4%. Now, the thing is that this is a little relief to the BOG, but it's still, raising questions whether they need to raise the interest rate at the end of the year or maybe the beginning of next year. And the reason why this question is still hanging there is because Japanese are not out of the woods. As you can see, this is a very, very nice decline compared to the previous number. But it's still very high, and the BOG is working. I mean, all central banks are working with the same system. That's why they sometimes, or most of the times, they're behind the situation with a couple of steps, because they need the confirmation that if you have an increase, they need to confirm with a trend-like increase. If they have a decline, they need to confirm also with the trend-like decline. Now, the first step to go down is just the first step. And it doesn't prove anything. There was a couple of times in the last 2 years when we experienced some decline in the CPI, but that didn't change the trend at all. In fact, the trend was just started to accelerate from that point. So there is nothing we could prove that the CPI is really, the inflation is really declining in Japan. There's the first step. There could be a decline out of this decline, but we need to wait another maybe 2 or 3 months to see this, and I am 100% sure that the BOGs also wants to see that. So the question whether the BOG will increase the rates or not, it will depend on other factors and not the CPI itself. Moving forward, so we have a very interesting data which came also Tuesday. This is the EU M3 money supply, which we are watching not because of the actual number or the actual change, because that data doesn't really have a huge impact on the Forex market or any other market sectors. But as I explained that to you a couple of months ago, the reason why we are watching the data, because we want to see if there is a trend-like change on the chart. And obviously we should not get scared because we got 1 or 2 increasing data. As you can see, we also experienced that in the last 2 to 3 years. But the chances, and always the chances, and then the confirmation on a very similar way. Then we are watching that in terms of the CPI, which I just showed you a minute ago. And there is an increase. So the previous number was 1.2% in minus, and then we got the minus 1%, which is a little increase. Now, this will raise questions whether the EU money supply is really bottoming at this point, or we're just experiencing another correction. We don't know that. I don't think it would be wise to, making any prediction from that point, but this is definitely a chance to form a bottom. And the reason why it's important, because if this would be a bottom and the money supply at least would start to consolidate for the long term, or even increase just a little bit, there would be a sign of that we are getting closer to a possible rate cut and not getting away from it. Because the further decline is obviously just pushing away us from that point. But just be aware that even if I am saying that we are maybe, if that's a bottom, we are getting closer to a possible rate cut from the ECB, that doesn't mean it's going to happen next month. Probably is not going to happen for a long time now. But again, that at least we are stopping at some point, and we start to calculate how long it takes, and not start to calculate how long it takes to get to the bottom. That's a big difference. So it's technically a good data, somewhat could improve the consumer confidence. Not with a big step, but this is technically positive for us. And then we got US CB consumer confidence, which was 102.6, and then before the data publishing, the previous data was revised to 99.1. That 99.1 point, and the new data become 102.0, which is an interesting data, because if we compare to the previous, now here is a question that which previous we are comparing to, because we got one is a 102.6 and the other one is a 99.1. And we need to look behind why the revision happened. And technically, if you compare to the original data, then we are worse than previous. If you compare to the revised data, then we are better than previous. So this is a very confusing analysis, because then you need to decide whether it's going to get a positive effect on the market or not. Usually the market is confused in the same way as any other market analyst in this matter. And what we need to focusing on is technically the original previous data, and we need to waiting until the next month USCB consumer confidence, and then we will see whether there is a revision or not. Because if there is a revision, then we're going to compare the two revision to each other. But if there is no revision, then probably we are good to compare to the original data, which is 102.6. And therefore, right now, the most possible scenario is that this is a negative effect on either the DXY and the stock market as well in the US. Because that's somewhat a decline. And so that's an interesting figure at the moment. I'm going to dig a little bit deeper into that. And if I have any additional information on that, I'm going to let you know, definitely. And then we got the Richmond Manufacturing Index, which became -5 after a positive 3. And that's not a good news at all, because that suggests that the manufacturing sector, especially in this area, is slowing further. So this means that we're experiencing some kind of retail activity in the background. As you can see at the end of the year, it's better to say that from the middle of 2023, we experienced some of the increasing figures, and that was, probably the manufacturing preparation for the end of the year. That was a very mild preparation, so we see that this Christmas is not the same as it was. I understand you see a lot of news about record high Black Friday, but in reality, I don't see this record high Black Friday in the stock market at all. So technically, we have the declining back, which suggests that we will have a very sad January, probably February as well, in terms of manufacturing, which is the supply itself. And if the supply declines, then this means that the suppliers do not really feel that they have the demand, and they don't have to produce as much as in a normal economic situation, which proves my previous analysis trying to suggest that we probably going to experience a huge economic backdrop in January and February, which would be very negative for everybody, but especially we need to take really care of the Q4 earnings from the companies in the United States. So that's definitely negative data for us. And on Wednesday, so yesterday, we received a 4.9% increase in the Australian CPI, which is a little bit less than it was in the previous data. That was a 5.6%. So probably the market is reacting. I mean, the economic market is reacting on a positive way as an answer to the last RBA rate hikes, and that's somewhat an understandable result. But again, this CPI number is still too high. It's very, very high, and it's still damaging the economy. So so despite the decline, I don't consider this as a huge improvement in terms of the economy. The New Zealand official cash rate become 5.50%, which means that they paused the interest rates further. This is a wise decision from the New Zealand Central Bank. So it's 5 months in a row they're leaving the rates at 5.5%, which is way higher than the 4.35% in Australia. So they probably are going to check out the Australian economy and the changes mainly. And they are somewhat lucky that they were a little bit more aggressive than the counterparts in Australia. So they got a little bit more playground to pause the interest rate hike, and just watching how the economy is changing in that period. So completely understandable decision. Why the German prelim CPI become minus 0.4%, which I was checked this data because that's a pretty huge decline in terms of the monthly CPI. And I did not really find. I mean, there are obviously declines in terms of the in terms of the CPI numbers. So when you break it down, almost every single basket item is declining on the paper. But I had a little bit of research on that, and I went to most of the major German shops and checked online the prices compared to the last month and the previous month prices. And to be honest, I didn't find many items that there were declined. So probably there is a glitch in the numbers of CPI calculations. And at this moment, obviously, that I don't mean that they are lying or cheating with the CPI numbers, but I think there is something I did not consider just yet with this declining CPI number, or there is some miscalculation with that, and I wouldn't be surprised if we're going to get a revision after this number in the next month, because that's something what we usually do or get. So again, I wouldn't be surprised. But what really needs to watching on this day is the US prelim GDP, which increased to 5.2% from 4.9% from the previous month, and also the preliminary GDP price index. Both of them are quarterly numbers, and this is also increased from 3.5% to 3.6%. And this is a sign that we are usually experiencing at the end of the year, that the economy is a little bit accelerating, but the rate of the acceleration compared to the previous numbers is not really aggressive. It's definitely not what I would expect from a really huge and aggressive Christmas spending period. So somewhat surprised because it's not as high as I was expecting, but at the same time, this is obviously positive, and as we saw, the DXY is reacting very positively. So no surprise here, but we need to calculate that we definitely have this positive effect from the DXY. But the DXY will experience two more very important data. I mean, one is more important than the other, and the more important is the core PCE price index, which is going to come at 2:30 this afternoon. This is Central European time, and the US unemployment claims, which is a little bit less important nowadays because we are rather watching the unemployment rates, because the US unemployment claims in this period, as I explained that in the last couple of times, would be a little bit misleading. if we are really trying to get some conclusion from this number, in terms of the, because the chances to get any kind of unemployment benefit is getting harder and harder, so it doesn't really represents the unemployment rate or the situation in the unemployment. And on this Friday, as I explained that to you earlier, there will be the ISM manufacturing PMI and the ISM manufacturing prices. There will be no non-farm payroll data on this Friday, which is the 1st of December. But we're going to get those data in next week on Friday. So this will be a very interesting Friday in any way. But in the overall conclusion from that, we have a neutral effect on the ETF and the stock market, while the commodity market is considering positive. The effect on the Forex market is somewhat negative. This means everything except the DXY. And the effect on the crypto market is still negative. So that doesn't mean that the crypto market is going down because of those economic data. But remember, the crypto market is focusing on the financial part of the macroeconomic sector, and not necessarily the manufacturing or whatever other economic sectors. So it's still negative, but let's go forward. There is no changes within the geopolitics, but I need to raise attention about Russia, because Russia is getting playing around a little bit, especially with the oil to China. So there will be some things what we need to watching. And also please pay attention for the OPEC meeting, which is probably occurring today if there will be no more delay this week. And this is very important for the oil numbers. We saw the market is trying to price in a possible further oil cut announcement. But that's why it's very dangerous, because I explained that to you last time, that technically OPEC has two options right now, and if they're choosing the other option, which is the bad option, then it will be a huge surprise on the market, and the oil prices could fall as hard as possible. So we just need to make sure that we are watching those meetings and get the right conclusion out of it. There's no changes within the corporate earnings field, so there's nothing new I can tell you. Now we start to focusing on the Q4 and the Q4 prediction. I'm still making some calculations in that, so there will maybe there will be some changes. I can't promise that just yet, but I'm gonna let you know probably in the next few meetings. And the market news, there's not much happened this week, but there's a couple of things I need to raise attention. So, for example, Walmart moves from China to India for cheaper imports. By the way, those news you can find on our website. The news category, so we have the updated news every single day, so you can check that out. And once you click on it, probably better to save it into bookmarks, because we're gonna posting fresh news and only important news every single day. So so this move from Walmart is actually a sign of clever playing for 2024, because now companies are trying to reduce as much expense as possible, and therefore now they are focusing on the commodities and the raw materials and everything what they need to in order to produce and sell. So that's something we need to focusing on, and I'm wondering how China will counterbalance this effect, because if that Walmart decision goes to India, then India might gonna get some trouble to China in the next 5 years, maybe, in terms of economic situation. Now there is another one. The US FDA signals new problem with Philips machines, shares falls. That's something that I consider a small problem, but there are more and more small problems that are coming up. I mentioned a couple of them last week as well, and the week before, and it's really concerning that the market is technically doing nothing, and meanwhile we just in the background we're getting those bad news towards individual companies, but those companies are indeed really big, so we need to pay attention for that. And obviously the warming US consumer confidence, what I just talked about with the macroeconomics. So this is somewhat concerning area, but the positive narrative is still staying in terms of the stock market. However, I just wanted to highlight a couple of a negative one because it is really important that we can balancing out the narrative what we are facing off on the internet. Now, in terms of the commodity market, we have the energy concern, well, especially the oil concern, and yeah, as I mentioned, most of the news outlets are talking about possible oil cuts. Production cuts. Which would be an obvious decision by the OPEC, but there is a reason why they're delaying this meeting all the time. So let me just raise your attention that there is two possible options, and as long as we don't know, there's just, if you look at the oil chart, you're supposed to consider this positive movement as an unstable movement, because obviously the market is reacting to something which is not confirmed just yet. So there's always trouble when the confirmation is going to the opposite way. And that's why that could be dangerous if you're stuck in a position. I had one writing which was posted this week on the website, and that's talking about the new gold standard horizon. It is really worth watching, but it's not a coincidence why I did posting this, because we're going to take a look on the gold chart today, and you will see how important is that for the next couple of years maybe. So this is still creating a positive environment for gold, and if we go to the crypto market, we also continue to get positive news. I had a talk with one of the members in the Discord server yesterday, and we were talking about that. How is that the crypto market is consolidating, but it cannot break the resistance to the upside while the volume is declining, and we are getting closer to a possible cycle closing on the total market cap. And yeah, that's something where we really need to talk about, because the crypto market is mainly reacting to the news and the narratives, because the crypto market is a baby market right now. Most of the participant is not really experienced in terms of trading and investments, and therefore they are reacting what they are reading and they're seeing. And so it is really important that when we have a consolidation, a long-term, especially a long-term consolidation, or maybe a smaller correction, if the narrative behind the market is still positive, and we can expect that the correction will be mild, and we still have the power to continue to the upside, unless something tragic happens in the economy or to the people. So that's still a positive background to the crypto, and I'm really happy to see that, to be honest, because that gives rational hopes to a better continuation. But you will see the chart very soon, and you will see that it's probably not going to happen tomorrow, but it's still very, very good. So yeah, that's the news, and we're gonna take the conclusion with the points about the news and the effects of the market news on the market sectors. But before we do that, let's see the market sentiment and psychology. Now, on the ETF index and stock market, as we see, the finance sector is somewhat declining in terms of the market sentiment, but the health sector is moving back towards the neutral territory, but it's still somewhat positive. But the tech sector is dropping very, very hardly in terms of the sentiment. Now, the state of the sentiment is not too negative at the moment, but the changes compared to the previous meeting, which was on Monday, it's pretty huge, and that somewhat sent us a warning signal that something is happening in the tech sector, and the retail it's getting to be in a negative mood, which is not very good, because the retail was driving this market in the last couple of months, especially in the last couple of weeks. And so we need to pay attention for this signal, and you're going to see with the overall points that what that means exactly. Now, the retail sector is on the same level in terms of the sentiment where it was on Monday, so there's no significant changes, but the consumer services are declining, and they're moving into a stronger negative territory, which is not too good. The car industry is obviously facing to an unchanged, mildly positive sentiment, so that's not too bad. But again, there is no huge increase while the tech sector is decreasing in terms of sentiment. So there is no use of automaker shares as any kind of safe haven. I know it's not safe haven. I don't get the criticism, but you know, that's the opposition what we're always looking for in the market, that where the money is flowing actually. So the transportation is also dropping back, not as much as the tech sector, but it's still a huge drop back since Monday, and it is a little bit more in the negative territory than the tech sector, while the energy sector is mildly increasing. So like something is preparing in the background. I'm quite happy to see that the energy sector was in positive on Monday as well, and now we see that on Thursday as well. But again, I would like to highlight, I'm not talking about all the energy shares, but that's an average sentiment on the market. And so this is not too good in overall, because as you can see, most of the sector is declining in terms of sentiment, and you will see that this is actually a quite important point to drop back in terms of the overall points to the ETF and the stock market. But before we take a look, let's see quickly the commodity market. The essential food is moving into a little bit deeper to the negative territory in terms of the sentiment, but the non-essential foods are increasing in terms of so they are. I mean, traders are really happy with that situation right now. Especially if you're watching the US cocoa chart, that's just going mad nowadays. And I'm pretty happy to see this because it gives us the opportunity for scalping. So I would like to see that there is a stable mood on the market in terms of the non-essential foods. The energy is improving, and that's what I told you, that that was pretty negative on Monday, and then we got the next 3 days. We are improving. If you take a look on the natural gas charts, for example, it's not the happiest chart on earth, but somewhat improving at the moment, while the oil chart is obviously improving because, as I said, the market is reacting to something. It's not happened just yet, but this is why it's very important and very dangerous. So if we see, for example, that the technical points are dropping while the sentiment is going up, that's the dangerous situation. The stable situation is when you see that the sentiment is increasing and the technicals are increasing as well. Then you have a stable structure on the chart, so you can trade it. But in that situation, you can't really trade it, or it's a very dangerous to trade. Now, precious metals are steadily positive, and I'm not surprised because everybody is very happy with the safe haven assets, such as the silver and especially gold, which just hit my first target I posted yesterday. So I'm very happy with that. But it stays positive, so I'm happy to see that. The industrial metals, however, dropping back a little bit, so this might be affecting a little bit silver in the next couple of days if this drop back continues towards the weekend and after the weekend. And the livestock is somewhat improving, but it's still in negative. So the main sentiment is still negative on the market, but somewhat probably slowing down in drop, which was expected because we, for example, in terms of cattle, we just broke the 200 EMA, and we obviously need to slow down the retest afterwards. So the next couple of days may be going to be a little bit more positive on the livestock area. In terms of the Forex market, we're going to take a look on the charts deeply, but before we do, I would like to explain that, as you can see, the DXY is still in a negative sentiment in terms of the bank. When we're talking about sentiment in the Forex market, I always emphasize that we are talking about the bank sentiment. And that's not too bad, by the way. We are just moving back a little bit, but I would like to highlight that this sentiment is still negative. It's just improving, so don't make mistake. There is no huge positivity. However, and that's what I told you week by week, that the EXY is technically a very weak asset, because there is just a slight slowdown or improvement on the DXY in terms of bank sentiment, but the DXY is immediately dropping huge with a much more step than the DXY is increasing. So this is a very weak asset, and I don't think that the ECB is very happy with that situation right now. So we need to keep an eye on EXY, because probably going to provide some of the opportunities for a little bit more experienced traders with riskier trades especially on the Euro USD chart. Now, the JXY is steady. That's good to see, because as you see that some of the XY improvement can be obviously visible on the technical charts as well, but the EXY is dropping back immediately, and the JXY is somewhat keeping itself up, same as the BXY, which, as I told you last week, that's a kind of surprise for me, because I expect a little bit weaker BXY performance, but that was pretty good so far in this week. But Q is also holding up with neutral changes or no changes in terms of sentiment. But as I said, we need to keep an eye on, especially on the ZXY and the AXY, because yeah, the CPI declined somewhat, but that's not, that's still very high, especially in Australia. Now, the CXY is dropping back somewhat, but it's not too dangerous in terms of bank sentiment. It's still in a positive area, which probably could cause by oil increase in the last 2 days, and also the silver, the aggressive silver prices. So probably helping to the CXY a lot, while the SXY is neutral and the XY is dropping back just a little bit, as I mentioned earlier. And if we take a quick look on the crypto market, the sentiment is slowing down further, but again, this is still in a positive territory. So we're declining since we started to do this longer term consolidation. And the good news is that we don't slip back immediately to negative territory in terms of sentiment, but instead we are trying to, the market is trying to keep on the positive side. We still get the positive news. The positive news in that situation is that we don't dropping so hardly, and I consider that a very, very friendly crypto environment at the moment. So if we talked about the crypto, I'm going to continue with the crypto on the technical terms. As you can see, we do this longer consolidation. We do not move out of this structure just yet, but we are patiently waiting for the middle. The median line of the Bollinger Bands, and it is developing to the upside very, very nicely. Now, this is possible that at the end of this structure, we will experience some kind of drop, but I am still very positive with this result, and I cannot say any scary or bad words just yet. Yes, obviously, the larger drops, the chances for larger drops is always there. Now, anything unexpected news, unexpected geopolitical event can happen. We need to calculate this into our trading activity. But otherwise, this situation of the crypto market, this crypto market balance is looking very balanced, and it doesn't seem like it wants to go big time, go to the downside with a big power. And if we take a look on, but yeah, there's just one little insight. If you take a look on the stock MTM, it's weakening, so probably we're going to decline. But this gonna take time, maybe until Christmas. I'm not pretty sure. It depends on really the market sentiment, but it doesn't show. Doesn't represent any power. So we probably continue to do this consolidation, or maybe a smaller correction to the downside. In terms of the volume, there is no surprise, because we are very weak in volume. So we're declining since the first really large spike. We're still unable to go above the green line. And that shows us that technically, the market is slipping away. There's less and less trading activity on the market. I don't think it's a bad thing, because, otherwise we supposed to, if we see now a larger volume, but a consolidation, I would rather expect a larger drop to the downside. But when we are seeing this pullback on the volume, and the price is still high and consolidating on a high level, then that probably means that in a fundamental way, the chart is making a correction now. And when the volume is coming back, we're probably going to move to the upside. But again, I'm going to explain that to you on the technical chart. So that means that we can expect a cycle close on the total market cap on 10th of December. which means probably we will experience some kind of negative movements to the downside. But if there is no changes in the circumstances I just explained to you, then probably the next cycle could be very, very aggressive to the upside and maybe attacking this 1.47 level and the zone above it. So I still consider a very positive situation on the crypto market, but we need to get patient. This is a consolidation. This is not the right environment for especially a beginner trader. And so just to make sure that you choose the right chart. But I'm gonna take a look on a couple of charts today and show you what do I mean. Now I have a new chart for the Forex index balance checkout. That's not what I used to use, but I just wanted to explain that if we take a look on the overall market, including the stock market, including the wicks, just to see how the volume of the sentiment is developing, the 10-year yield and the DXY, then we have a very clear picture that there is a slowdown in decline in terms of the DXY. The DXY is the green line, by the way. The 10-year yield is the blue line. This pink line is going to represent the VIX, and obviously the purple is the S&P 500. Now, as you can see, there is a slowdown in decline both in the DXY, somewhat slowdown in the 10-year yield, and the VIX is spiking to the upside, so probably trying to find the bottom, which means that if the VIX is starting to accelerate to the upside, that's some kind of fear on the stock market, which wouldn't be a surprise because the SPY doesn't do anything at all for massive days now, and that means that even the retail is running out of the power, which could be very positive for the DXY. The question is that what kind of macroeconomic changes will be, or what kind of results we're going to get on next week, and especially with the non-farm payroll. And as I told you about one and a half months ago, it is hardly possible that before the Christmas we're going to see some kind of stronger economic data in the United States, as we do that. We experience that every single year. It's a little bit slower than I expected, and it's slower than the last year, but it's still somewhat, it looks like the economy is strengthening. It's a false information because that happens because of the end of the year, because of the Christmas time, and when we probably the scenario is the current most possible scenario is that when we're moving to next year, January, February, we're gonna experience a huge drawback, and probably in retail sales as well. So a large slowdown is expected, but before that, we could experience some acceleration in terms of retail sales. Obviously, GDP could go up, as we just experienced with the preliminary numbers. And so this is all positive environment for the DXY. And if the DXY is moving into positive direction, it doesn't really matter if it's making a new higher high compared to the previous one or whatever. If the DXY is backed up with the macroeconomics and moving to the upside, the rest of the Forex market could go to the downside, especially the euro. But there is a couple of currencies, for example, the Japanese yen has its own problem to solve, but they need to push it hard. And it is possible when the DXY is going to rise a little bit, that maybe the GXY is going to follow. We're just happy with that because in this situation, we would get two positive currency index, and then we can choose the right currency pair out of these two, because the rest of them probably going to be negative. So it's like a Forex trader heaven if we get two positive, but it's not, it's not happening very often. So the balance is, it looks like the DXY is trying to find some kind of bottom. It would be supported by other market sectors, but there is no proof of it just yet. So I think the main, I think the most important thing to watch here is the 10-year yield. If the 10-year yield is making a new higher high, and the last higher high was this little spike to the upside. So if we can exceed this level to the upside with the 10-year yield, that would be a confirmation, a fundamental confirmation to the DXY that it could continue to rise for some time, but that rising would be pretty much stable. Now, moving to the stock market and the ETF market, as we see on the options market balance, it's pretty much balanced. So there is no majority on put or call contracts just yet. With the on the SPX, we are experiencing some kind of building to the upside with the higher lows and the higher highs in the last two waves, especially. But it's not major. The SPY is pretty much balanced, so there is no decision by the options market whether the market is supposed to go down or up. I think it's driven by the Wall Street right now, and the Wall Street is just riding the waves. It didn't decide, which means that the market is still waiting for the big guys to push the red or the green button, and probably we're gonna see the red one, but you never know for sure. So there is no changes. There is a complete balanced out market, and that's the scary thing, because despite the balanced out market, we see that an uptick on the weeks, which is not, it's not calming the market at all. And again, despite the balanced out market, we don't see that the SPY is technically doing something. I mean, there is a very, very mild increase compared to the data what we got, compared to the prices what we got 7 days ago, and we are nowhere since that level. So it's 1.5 weeks gone without changing any major prices. This is a complete slowdown on the retail, and that's the dangerous, because the options market is also balanced out. So there will be a breakout into one direction, and the best thing that a trader can do in this situation is that get the trend lines to the right level, and wherever is the breakout, you need to ride that, because if we break out from this fundamental consolidation what we experience on the market, for some time we will experience increased volume, that's for sure, and that could provide some stable direction. Whether it's to the upside or to the downside, it doesn't really matter, but you just need to ride that, and this is the most important part of it. Now, if we take a look on the stock market balance, as you can see, the RSI is completely overextended to the upside over the 70 line. It's slowing down somewhat, but there is no proof that it wants to decline in terms of structure. The MACD is losing the power. That does not prove that we're supposed to go to the downside. The only proof that the MACD is showing that currently we are losing the steam. What was responsible for the last, let's say, bull run to the upside, but that was driven by the retail only. And if the retail is getting tired out, that shows to the big guys as well as that shows to the Wall Street as well, that it doesn't really matter if they are trying to pushing to the upside. If the retail does not want to buy, there is no narrative they can provide to the chart, so they need to push the red button instead of the green button, and that's what I think is going to happen in the close future. I'm not talking about a huge market crash. I'm talking about a possible correction. Maybe the scaling is going to catch the price. I don't know, but at least we need to close this gap. So if we take a look on the stock MTM, because if that's true, and if there will be a correction, even if that correction it will be just a minor one, you rightfully raise the question, when can we experience that on the stock market or the ETF market? And there is a very, very easy answer. If we take a look on the SPY stock MTM indicator, is just about to cross over. This is the state of the preparation for a possible correction, and that's because the power is obviously, the buying power is completely getting to disappear from the market. And when we're crossing the 40 line to the downside, with both of the moving averages on the stock MTM, this is the confirmation that the actual correction is ongoing right now. So this is what you need to watch in that term. So moving forward, so I just watched that my clock. So moving forward, let's just take a quick look what the overall point shows us and what our prediction for the market sectors shows us, because as you know, and hopefully you know already, this overall point is showing an almost perfect prediction so far. Since we are doing this kind of calculation, this point is always was right, and tried to previously predicting what the market is about to do. And the only reason why the overall point is able to do that, because when we're calculating the overall point, we take into consideration all the major drivers of the market. So the macroeconomics, the geopolitical, the corporate earnings, market news and events, market sentiment and psychology, and the technicals. And so this is why I went through with you in all of that, what the new information, what the narrative, what market effect we can experience on each market sectors. And this is when we are breaking down or making a summary at least. And so if you take a look, there is no changes in the macroeconomic effect on the ETF market. Geopolitics is also unchanged. The corporate earnings is also unchanged, but all three is in negative right now. And this is just proof the situation that we fundamentally in a bear market in the ETF market. And the whole reason why the prices was able to go to the upside with any kind of bull market run, even on the SPY, is that because the narratives, it depends on the market news. And if you take a look on the points on the news, yes, the news were declined as well when we went to the downside, but since then we got pretty aggressive news to the upside as well. Now this is slowing down. It's still increasing somewhat. We still got the somewhat positive narrative, but it's slowing down in increase, while the sentiment is declining back to -3 points from the previous positive one. And this is the warning signal what I just mentioned to you, because the technicals are not declining, but it's consolidating on one level, which means that charts, ETF charts mainly, are not necessary to start its job, but because the technical points is in a downward wave, that means there is. I don't see from the points that we would make an upside correction at the moment. If we take a look on the overall points, yes, it's dropping back from -40 to -43. And first we saw the slowdown, and now we're seeing the decline in terms of points. So as of my best prediction for the ETF market is that probably going to experience some kind of correction in the upcoming days to the downside. So what we need to watching on this market sector is that the trend direction, which is fundamentally bearish, technically in some charts are bullish, but for example, the Russell is not everything but not bullish. So it's completely unstable, and the direction stated is that most of the charts are in consolidation. Now, when we're talking about that, the charts are moving to the direction of the trend, which is fundamentally bearish, is that because of the macro and the earnings situation? But the surprise, so what can change the direction very suddenly could come from geopolitics, news, sentiment, and technicals. So because we do not have a stable trend direction at the moment, and we are consolidating, especially, all market sectors within the ETF sector could be considered as risky sectors. And the main risk on the market right now is that even though most of the ETF chart moved to the upside a little bit, we are losing the power which was providing this lifting, and we are completely slowing down, and probably, we're definitely consolidating with all charts. This is the main risk, because if the power cannot come back, that means that the retail cannot come back to the buying side. We definitely gonna make some corrections to the downside. So there is the risk on the ETF market. The commodity market is not changed a lot, but there is an interesting change, because there is no changes in the macroeconomics point, the geopolitics point staying the same, but the market news and events somewhat increasing from 2 to 3, and it's still in positive territory, so pay attention for that. The market sentiment is improving, but as I said, this is, especially in terms of the energy sector, it's somewhat early reaction, so we need to make sure that there is a technical increase in terms of points. And if we take a look on the technicals, there is some kind of increase. So the reaction could be valid, And therefore, the overall point shows us that the previous 39 is increasing to 42, which is very positive for the commodity market. Now, it's not only the energy sector, but it's also including almost all market sectors within the commodities, like precious metals, industrial metals, essential foods, non-essential foods, livestock, energy, whatever you can find. But I need to emphasize that the point does not represent every single market sector. So, for example, while the industrial metals are struggling and not expected to go higher, because obviously we need at least a prepared industry to start showing up some demand. There is no such a situation right now. There is a continuously slowing down economy, despite the better Christmas time numbers. The background situation, the background economic situation, the background economic problems do not go away just like that. So this point right now is rather represents the precious metals, the energy sector, maybe non-essential foods or essential foods. So anything could provide some kind of safe haven, asset on the market. So it's pretty positive. We have a mixed market because not everything, as I just mentioned, is in bull trend. For example, most of the industrial metals are in bear trend. The direction of the trends are at the moment are consolidation or just about to start a consolidation. We're going to see, for example, on the gold chart today, the power of the trend is coming from the macroeconomics and the geopolitics, but the surprise, what we need to look for, is from the technicals, the sentiment, and the geopolitics as well. Obviously, because geopolitics has a huge power over the commodities. And so right now, all market sectors requires high attention from us because of the consolidations, and it's still considered an unstabilized market, and we are depending on other market sectors. But that's a good news, by the way, because when the commodity market is depending on other market sectors, that means that the commodity market is mainly used as a safe haven, which means a very negative overall market sentiment, on the stock market mainly. So good news on the commodity field. On the forex market, as we see, there is no huge changes, no changes in macroeconomics. Geopolitics stays the same. Market news is staying the same. There is a little decline in the market sentiment. That's obviously a reaction to the DXY increase. But the technicals are also declining back a little bit. That could be a warning signal. So what we see here in the overall point is that the previous minus 25 is declining back to minus 27. And there is just one time since this rising phase when we experienced some decline and then we pulled back the points. So what I would like to highlight with that is that if the next point on next Monday is a declining again, that could be a proof that the DXY may be really finding the bottom, and the rest of the market may be going to the downside. So that could provide very good opportunities, by the way, on the forex market. So we are in a rejection phase right now, as you experience, especially with the euro index. And the main risk, what we need to pay attention for, is the possible DXY bounce back. This is what we need to watching. So we need to get the technical charts. We need to investigate the structures, and when we start to break the structures to the upside with the DXY, that could be a proof that yes, there is a market stabilization to the negative side. Because obviously, when the DXY is going up, and almost everything else, is going to go to the downside. The stock market is very similar. It's reacting very similarly than the ETF market. The changes are very similar as well. And the overall point is also declining further. Now, on Monday, we already had one decline from minus 52, from minus 51 to minus 52. And now we are declining further to minus 53. Now, this is not a huge drop. It's not an aggressive decline. So I just, highlight that. Don't expect some, very drastical drop unless there is something really affecting the individual stock or the company behind, or there is or maybe there's just some drastic geopolitical event happens, or we're gonna get really unexpected, very bad macroeconomic data, which I don't see we're gonna get that now. So unless these happens, it's not gonna be a huge drop just yet, probably, but we already tuning to the downside. And very similarly, as I just told you, on the forex market points, if we see the second number declining, that could be a proof that somewhat we are stabilizing to the downside. And I think on the stock market we are somewhat stabilizing to the downside. So that's a pretty good news, because that's what we're going to look. I would like to highlight that the surprise possibility, most of the surprise possibility could come from the technical chart. In fact, because the technical point has started to drop pretty aggressively, that means that it's already happening. And so if you was believing that you can go only to the upside and now you're surprised why we are turning back, for example, the Apple chart is very sad nowadays, it's why it's happening. And that's happening because you wrongly believe we are only going to the downside, and further surprises could come from the technical chart. So pay attention to the analysis, what you're doing at home. And in terms of the crypto market, no big changes. Most of the changes coming from the market sentiment. There's a very mild, continuous decline. But again, this is very mild, and this is very understandable because we are in a correction. So we get the proof that not all the people are just buying on the crypto market right now. So why would you, if not everybody is doing it? And the technicals are also declining, only 1 point still in a positive territory. Therefore, we can see the overall point is declining from 25 to 23. It's still a very minor decline. It's still part of the consolidation. So I wouldn't be really scared about that. And I think, as I explained that, we can expect further corrections. So whoever is trying to play a cowboy game and trying to trade the crypto market right now, for those people, the main risk is the further correction or consolidation, and they will probably rightfully lose their money because they tried to trade somewhere that it shouldn't be traded. Now, what that means exactly. So for those pro members who are going to stay on this live stream and the video afterwards on the pro server, I'm going to show you a couple of technical charts. Who doesn't stay with us for the technical charts, then I wish you very good luck. Or it's not a good thing to wish a good luck on the market, but sometimes, people just don't listen too much. So whoever don't listen, then good luck. Whoever listen, then all the best I'm wishing.